Real insights, no noise. The K-Show. The K-Show.
Welcome to another exciting episode of The K-Show. Today, we're diving deep into the future of money, exploring the intriguing worlds of fiat currencies, cryptocurrencies, and everything in between. I'm your host Kay, and joining me is my good friend, Manish Shankar, Regional Head of Strategic Solutions at IndusInd Bank. Manish and I go way back, 7 incredible years, in fact, since our days together at Booth School of Business, the University of Chicago. It's fantastic having you here, Manish.
Thank you, Kay. I'm thrilled to be here, especially talking about such a fascinating topic. Fiat currency, cryptocurrencies, trust, technology. There's a lot to unpack today.
Let's start with the basics, Manish. What is fiat currency, and how does a country simply declare its money real?
Great question. So, fiat currency is essentially government-issued money, like the dollar, euro, or rupee, that isn't backed by gold or any physical commodity. It holds value because the government says it does, and more importantly, because we collectively agree to trust that value. Now, when a country declares its currency as legal tender, it's saying, "This is the official money. You can use it to pay taxes, buy goods, settle debts." That declaration is what gives it legal weight. But here's the deeper layer. It's not just the government saying, "Use this." It's the entire system, from central banks to the courts to the people in the marketplace, believing that the money will retain its value tomorrow and next year. That trust is built on how well the country manages things like inflation, interest rates, debt, and political stability. So, in short, fiat is a social contract. It's trust in paper, backed by the credibility of a nation. And if that trust breaks down, like in cases of hyperinflation, it's just paper again. Oh, you lose belief, you lose value. That's the paradox of fiat. It's both fragile and powerful, entirely depending on trust.
How do central banks reinforce that trust?
They essentially steer the economy using tools like open market operations, interest rate adjustments, and reserve requirements for banks. By doing this, they keep inflation in check and facilitate liquidity during crises. If done well, people and businesses continue to trust the currency for day-to-day transactions and long-term savings.
Why does the US dollar hold such a dominant position globally?
Because of America's substantial economic power, global trade networks, and well-established financial institutions. Dollars are accepted almost everywhere, and US bonds are considered among the safest assets. This global reliance on the dollar perpetuates its status as the world's reserve currency, reinforcing a cycle of trust.
What about the gold standard? Where did that go?
It was effectively ended in 1971 under President Nixon because pegging currency to gold limited how much governments could respond to economic shocks. In times of recession, you couldn't just inject more money into the system if you didn't have the gold reserves to back it. Once gold backing was removed, currencies floated in value based on faith in governments and central banks instead of a metal in a vault.
So essentially, it's trust that gives money its power.
Absolutely. Once people believe a currency is worthless, the bills in your wallet become no more valuable than scraps of paper. That's why maintaining confidence is paramount for central banks and governments,
Manish, let's flip the coin, crypto. What makes it trustworthy if there's no government backing?
Code. Cryptocurrencies rely on consensus algorithms, like proof of work or proof of stake, to make sure no single person or group can fake or reverse a transaction. It's a system where math replaces middlemen. You don't need to trust a central authority. You trust the protocol, which is open, auditable, and enforced by thousands of participants.
How does crypto adoption stack up compared to fiat?
We're still early in the adoption curve. Fiat has centuries of head start and full legal recognition worldwide. Crypto, on the other hand, is rapidly evolving. Stablecoins and fintech bridges are making it more usable every day, but issues like regulation, ease of use, and volatility still need to mature before it's truly mainstream.
Let's talk about volatility. Why are crypto prices so erratic?
A few reasons. First, crypto markets are still relatively small in terms of liquidity, so a few large transactions can move prices drastically. Then there's speculation, people buying not for use but to flip. Add in the influence of social media, news cycles, and major holders, known as whales, and it creates these wild swings. Without a central bank smoothing things out, it's a pure, emotional, supply-demand equation.
And the philosophy behind it?
It's about decentralization and personal sovereignty. With crypto, you become your own bank. There's no one who can freeze your funds, censor your transactions, or inflate your currency. It's a radically different approach to financial freedom, but that also means more personal responsibility and sometimes higher risk.
But how do you prevent bad actors in a system with no central authority?
The beauty of consensus. Whether it's proof of work or proof of stake, the network punishes bad behavior economically. To hack Bitcoin, for example, you'd need to control over 50% of the network, a multi-billion-dollar endeavor that's nearly impossible to pull off. And with newer models like POS, cheating costs you your stake, so honesty is literally baked into the economics.
Let's bring it back to the user. What's holding people back from using crypto every day?
Honestly, friction. Wallets can be intimidating. Security protocols are different. And sometimes people don't know where to start. But that's improving fast. Companies are designing crypto apps that feel just like Venmo or Apple Pay. Once the user experience is seamless, adoption will accelerate.
Are stablecoins the bridge?
Absolutely. Stablecoins like USDC or USDT give people crypto speed and flexibility without the fear of price crashes. You can send $100 across the world in seconds and know it'll still be $100 when it lands. For daily payments, remittances, and e-commerce, they're a game changer.
So in a nutshell, what does crypto bring to the table that fiat can't?
Transparency, programmability, and global access. It's like money with a built-in API. You can build rules into it. Say, release this payment only if a package is delivered. Try doing that with paper bills or even traditional banking. It's slow, manual, and expensive. Alright, Kay, enough with the warm-up. Let's pop the hood and get into the engine of this thing. I want zero fluff, max clarity. What is blockchain really, and why is it rewriting the rules of trust?
Game on. Think of blockchain as the world's most secure, global spreadsheet, but with a twist. It's not stored in one place. It's duplicated across thousands of computers, constantly syncing in real time. Every time someone transacts, everyone's copy updates. If even one node tries to cheat, the network kicks it out. No shortcuts, no secrets, just pure math-driven integrity. Traditional databases live behind locked doors. Blockchain lives everywhere. And that's its power.
So boil it down. Give me the one-line definition.
It's a decentralized, tamper-proof digital ledger where trust is outsourced to math not middlemen.
Now plug that into Bitcoin. How does this architecture make it bulletproof?
Bitcoin is blockchain in action. Every transaction becomes a permanent line in a global, unchangeable ledger. No bank can freeze it, no hacker can hijack it. To cheat the system, you'd need to control 51% of a planet-sized network. That's billions in energy and hardware. It's not just hard, it's practically sci-fi impossible. That's why Bitcoin is called the most secure computer network ever built.
And you've said this tech is revolutionary. Why?
Because it flips the entire idea of trust on its head. Until now, trust meant institutions, banks, courts, governments. With blockchain, trust is in the protocol itself. It says, this happened and here's the math to prove it. It's like giving the internet a bulletproof memory with built-in truth.
All right, let's turn up the heat. How do these transactions actually get verified?
Welcome to the beating heart, consensus. In proof of work, like Bitcoin, miners solve insane math puzzles. It's competitive, energy-heavy, but ultra-secure. In proof of stake, validators lock in their own coins as collateral. If they cheat, they lose their money. So whether it's computational power or financial skin in the game, blockchains make cheating stupidly expensive. That's baked-in honesty.
No governments, no corporations, just consensus.
Exactly. A global hive mind of strangers, all agreeing on what's true without ever needing to know or trust each other. That's the magic.
Okay, most terrifying scenario. What happens if someone loses their private key?
You're done. Locked out. No reset button. Your private key is your access pass. Lose it, and your crypto is gone forever. It's like having a vault with no backup key. That's the price of total control. Complete freedom, but zero forgiveness.
Now let's address the big debate. Why do people say crypto is better than fiat?
Because crypto isn't just money, it's programmable value. It's transparent. It's borderless. And it can think. You can build logic into money. Only release funds if a package is delivered. Only trigger payment after a service is completed. Fiat can't do that. Bank wires can't do that. Crypto takes money from passive to proactive.
All right, time for the high-level wrap. What's the real takeaway?
Blockchain isn't hype, it's evolution. It removes the need for middlemen, swaps institutional trust for mathematical consensus, and introduces programmable, self-executing money. This isn't just a better system, it's a different universe, and we're just getting started.
I open up CoinMarketCap, and it's a jungle out there. Thousands of coins, each claiming to be the next big thing. But how does a project even decide what type of token to build? Payment, governance, meme, stablecoin, DeFi? What are we really looking at?
Great question, Manish. Think of it like a digital safari. You're staring at a zoo, but each species has a distinct purpose. If a project wants to move money across borders instantly, that's a payment coin. If they want the community to vote on how the platform evolves, that's a governance token. Let me break it down. Bitcoin's the OG. Digital gold. Fixed supply, decentralized, deflationary. It's sound money on the internet, globally trusted, no frills. Ethereum, the smart contract king. A programmable blockchain powering Web3, from NFTs to DAOs to DeFi. Think of it as a decentralized app store. Stablecoins, the steady ships. Pegged 1:1 to fiat, like USDC or USDT, they're ideal for savings, payments, or escaping crypto volatility.
Meme coins, the wild cards. Born from internet culture, Dogecoin, Shiba Inu, they're powered by vibes, not fundamentals. High risk, high community energy. DeFi tokens, the power tools. Tokens like UNI or AAV let users lend, borrow, trade, or even govern protocols, all without banks. So, yeah, it's more than coins. It's infrastructure, ideology, and in many cases, culture. Every coin is a narrative. Understand the why, not just the ticker.
K, let's get into the DNA of tokens. When builders create a new crypto project, how do they decide what kind of token it needs? Payment coin, governance token, what's the playbook?
It starts with the mission. If you're solving for fast, global value transfer, you build a payment coin. Something lean, quick, and borderless. But if your goal is community governance, letting users vote on protocol rules, fees, or upgrades, you launch a governance token. That's like issuing digital shareholder rights. You don't pick the token type for branding. You choose it based on the function it must fulfill in the ecosystem.
Got it. But what really builds trust in any of these tokens?
Great question. Trust is earned through transparency and resilience. You're looking at code quality. Is it clean, audited, battle-tested? Network size. How many users, validators, miners support it? Governance transparency. Is it controlled by a few wallets or an open community? And in the case of stablecoins, reserve integrity. Are those dollar-pegged promises backed and verifiable? If you can tick those boxes, the trust scales with adoption.
All right, teach me like I'm 5. Proof of stake, what is it in sandbox terms?
You lock up your coins, like putting lunch money on the table. If you behave and validate transactions correctly, you earn a reward. Cheat. You lose your lunch. It's blockchain kindergarten. Be honest or get punished.
And proof of work, the original heavyweight.
Miners compete by solving complex cryptographic puzzles. Think of it like a math race. Whoever solves it first validates the block and earns Bitcoin. It's secure because cheating is brutally expensive. You'd need enormous computing power, energy, and time to even try, and you'd still risk losing everything. That's why it works. It turns truth into a race you can't fake.
Last one, stablecoins. Why are they the favorite in the crypto toolkit?
Because stablecoins are crypto's calm center. Fast like crypto, stable like cash. No wild swings, just instant, reliable value across borders. They are the go-to for freelancers, cross-border payments, and anyone avoiding inflation or banking delays. It's the perfect bridge between DeFi and real life. Let's get real. What's crypto's biggest headache right now?
Regulatory identity crisis. Is it a currency, a commodity, a security? No one agrees. And when regulators don't define it, innovators get stuck in limbo.
What about DeFi?
It's both revolutionary and regulatory chaos. It cuts out banks, automates finance, and regulators don't know whether to embrace or restrict it.
Top risks.
Volatility, hacks, and fraud. Crypto lacks the FDIC cushions of traditional finance. One exploit can cause a domino collapse. Just ask any DeFi protocol post-hack.
Why are laws so scattered?
Because every country has its own agenda. Some want to be crypto havens, others fear capital flight or monetary loss. It's policy versus progress.
But can regulation actually help?
Yes, if done right. Regulation brings credibility. Think of it as a guardrail, not a handbrake. It's the difference between chaos and mass adoption.
What's the most practical win crypto has delivered?
Remittances. Migrant workers sending money home used to lose 10% in fees. Now they send stablecoins instantly for a few cents. More money in pockets, less in middleman vaults.
How do wallets really work?
They store your private keys and let you sign transactions. Hot wallets, online, fast, but vulnerable. Cold wallets, offline, slower, but bulletproof.
Stablecoins again.
Yes, because they are usable daily. No volatility. Just dollar-tied speed and convenience. That's game-changing in unstable economies.
How do companies accept it?
They use crypto payment processors that instantly convert to fiat. No risk. Just speed.
Will crypto go mainstream?
Already is. With Layer 2 scaling and cleaner UX, crypto's shifting from geek niche to global norm. Okay, let's zoom out and go meta. Everyone hears about new coins launching every day, but how does one actually make it? I'm talking real currency, something everyday people can use, not just speculate on. What's the real journey from white paper to wallet?
Great question, Manish. But before you even write a white paper, you need one thing most projects skip, the business case. Here's how a serious project begins. Step 1. Define the problem. What system is broken? Is it expensive remittances? Lack of banking access? Cross-border payment delays? Identify the pain point clearly. Step 2. Know your audience. Who benefits from this coin? Freelancers, NGOs, retailers, platforms, governments. You're not just building code. You're building trust for real people. Step 3. Why crypto? Why is blockchain the best tool for the job? Is it speed, transparency, decentralization, or global access? Prove that traditional finance can't fix this better. Step 4. Sustainability model. Will the token fuel an ecosystem via transaction fees, DeFi utilities, or governance models? No sustainability, no long-term traction. Step 5. Regulatory fitness. Can your coin survive scrutiny? If not, institutions won't touch it. That means no scale, no integration, no adoption. Step 6. Long-term utility. Does it stop at payments or evolve into infrastructure? Great coins become invisible. They just work across services, borders, and business models. You can't fake utility. You build it. The rest is noise.
So once you've got that business case, what's next?
Then you get to build currency, step by step. Step 1. Creation by trusted builders. Who you are matters. Founders must be visible, reputable, and accountable. Look at USDC. Circle and Coinbase gave it weight from day one. People buy belief before they buy tokens. People don't buy coins. They buy confidence. Step 2. Establish a stable peg. Volatility kills utility. Stablecoins tie each unit to something real, like USD. It's financial gravity. That's what makes them usable for payrolls, subscriptions, aid, or savings. Think of it as anchoring your currency to a rock in a stormy ocean. Step 3. Deploy on a public blockchain. Launch your coin on a secure chain, Ethereum, Solana, or Layer 2s like Arbitrum. This gives you global reach, instant interoperability, visibility and dev support. It's like listing your currency on a borderless stock exchange. Step 4. Regulatory compliance and AMP, transparent audits. This is where hype dies or becomes a headline. You need third-party smart contract audits, reserve proof, licensing from bodies like FinCEN or the SEC. This is how crypto becomes credible. Without this, it's just a meme with a white paper. Step 5. Exchange listings. You're nothing without access. Your token must be tradable on centralized exchanges, Coinbase, Binance. Decentralized platforms, Uniswap, PancakeSwap. Liquidity is not optional, it's survival. Step 6. Wallet and app integration. Adoption explodes when crypto becomes invisible. Integrate with wallets and apps people already use. MetaMask, Coinbase Wallet, Payroll, e-commerce, PayPal, Stripe. When grandma can send crypto to her grandkid, you've hit mass UX. Step 7. Real-world use cases. Make the token do something useful. Freelancers paid in crypto. NGOs using stablecoins in war zones. Startups billing in USDC. Consumers paying Netflix subscriptions in crypto. Every real use case equals trust earned.
Step 8. Mass trust, mass currency. Once a token is used, trusted and relied upon, it becomes currency. It stops being speculative and starts being infrastructural. At this point, you haven't just built a coin, you've launched an economy.
So a coin doesn't become money just because it's digital, it earns it. Through architecture, credibility, real-world use, and relentless clarity.
Exactly. You don't mint money, you design trust, line by line, block by block. Crypto doesn't replace fiat, it transcends it when it solves what fiat can't.
All right, Kay, let's unlock one of the most powerful promises of blockchain, smart contracts. No buzzwords. Just tell me, what's the real magic?
It's simple and brilliant. Smart contracts are programmable rules that execute automatically. If A happens, do B. No lawyers. No middlemen. No delays. Just pure, trustless automation. They are the invisible infrastructure that lets crypto do things, not just hold value.
Where in the life cycle of a crypto project do they come into play? Stage 3 and beyond. Once your token is live on a blockchain, smart contracts are the engine under the hood. They define how it moves, how it behaves, and how it integrates into the real world. Want your stablecoin to stream payrolls in real time? Want your DeFi app to handle loans without a bank? Want your NFT to unlock digital rights automatically? You build that logic into a smart contract. It's where code becomes law. Give me real-world proof. Where are these running today?
You'll find them everywhere if you know where to look. Insurance. You crash your car and the payout triggers instantly once sensor data confirms it. Real estate. Title transfers happen on-chain once conditions are met. Zero paperwork. Logistics. As a shipment hits checkpoints, payments are released automatically. No need to chase invoices. It's the back-end automation of the global economy, minus the bureaucracy.
K. Crypto often gets criticized for its energy consumption. But can it actually be sustainable? And are smart contracts just technical tools or something bigger?
Great question. Yes, Bitcoin's proof of work does consume energy, but that's intentional. It secures the network through difficulty. That said, Ethereum's move to proof of stake slashed its energy use by 99.95%, proving that cleaner models are not just possible, they are already here. But here's where it gets more exciting. Blockchain isn't just less harmful, it can actively help the planet. It can track and verify carbon credits, certify green energy trades, build decentralized, peer-to-peer energy markets, and smart contracts. They are not just lines of code, they are the invisible infrastructure enabling this transformation. They automate trust. They ensure transparency. They power systems where no middleman is needed. Used responsibly, Blockchain becomes the operating system of the green economy, and smart contracts are the logic running underneath it all.
K, let's cut to the heart of it. We've talked about tech, economics, and innovation. But what does crypto really mean for the everyday person, the unbanked, the underserved? It means freedom. Let me paint you a picture. In rural Kenya, a young woman named Abina earns money weaving baskets. Her village has no bank. But she has a phone. With a crypto wallet, she's selling her products online and receiving payments in stable coins. No intermediaries. No borders. No fees draining her earnings. That's what crypto unlocks, the ability to earn, save, and transact without ever stepping into a bank. And for people dealing with hyperinflation.
Real story, Argentina. 2023. The peso loses nearly 50% of its value in a matter of weeks. People there turn to USDT and USDC, not out of hype, but out of necessity. Stablecoins became digital savings accounts. Grocers accepted them. Freelancers asked to be paid in them. It wasn't a trend, it was survival. In places like Venezuela, crypto isn't optional, it's oxygen.
But scams, aren't they everywhere in crypto?
Yes, and that's where we need maturity. We don't just need regulation. We need education. Think of it like fire. It can cook your food or burn your house down. People need tools, wallets with built-in safety nets, and content that teaches, not just sells. Platforms like Trust Wallet or Coinbase Wallet now include scam alerts. This is how the space evolves, from chaos to caution.
Can blockchain actually fight corruption?
Absolutely. Picture this. An NGO distributes aid after an earthquake. Instead of handing over cash to intermediaries, they issue stablecoins directly to affected families. Every transaction is on-chain. Every coin is traceable. In India, there have been pilot projects using blockchain to track midday meal schemes and agricultural subsidies, cutting leakages drastically. Transparency becomes public infrastructure. That's how corruption dies.
So this is bigger than just tech. This is justice.
Exactly. This is about rebuilding trust where the old systems failed. Crypto is not just money. It's the first tool in a new toolbox of financial liberation, inclusion, and accountability. Let's zoom in. Central bank digital currencies, CBDCs. Are they the end of stablecoins or the beginning of something bigger?
They're not a threat. They're a layer. CBDCs are your digital rupee, yuan, or dollar. Reliable, centralized, compliant. But stablecoins like USDC, they're fluid. They live inside DeFi, power NFTs, run Web3 payrolls, and move across borders at the speed of thought. Picture this. CBDCs are the subway. Predictable, fixed paths. Stablecoins are Uber, personalized, on-demand, and borderless. Both serve a purpose. But only one reinvents the journey.
So are CBDCs a threat or an ally?
They're both. CBDCs bring legitimacy, yes, but they also bring state visibility. Imagine a government tracking every cup of coffee you buy. That's why stablecoins and DeFi matter. They preserve privacy. They defend the open financial rails. The challenge? Crafting a world that offers efficiency without surveillance and control without control freakery.
Where exactly are we on the adoption curve?
We're in the dial-up era of crypto. But make no mistake, the wave is rising fast. Nigeria is rolling out CBDCs. Argentina and Venezuela rely on stablecoins to protect against inflation. From Mumbai to Manila, freelancers are earning in USDC, not rupees or pesos. This isn't theory, it's reality. Mass adoption isn't a dream, it's already moving through the pipes.
But is fiat finished?
Fiat's still king, but only in the offline world. In digital life, we're heading to a multi-currency economy. Earn in USDC. Pay rent in INR. Buy NFTs in ETH. Invest in AAVE, Link, or even DAOs. Fiat won't vanish, it'll coexist. But crypto will lead where speed, scale, and freedom matter.
What about scams, rug pulls, and hacks? That's the elephant in the room.
Absolutely. The final boss of this story is trust. But we're not fighting it with fear, we're upgrading the system. KYC and AML protocols baked into wallets. Smarter contracts with guardrails. Global watchdog DAOs publishing scam lists in real time. This is evolution through education, not censorship.
All right, Manish, your final word. What's the future of money?
It's programmable. It's borderless. It's multi-dimensional. The future of money isn't one coin. It's an ecosystem. CBDCs for trust and institutions. Stablecoins for everyday freedom. DeFi tokens for innovation and access. Money won't just move fast, it will move intelligently. Kay, I'm challenging you. Name 5 blockchain plays, one each for shipping, ag finance, chips, humanitarian aid, and tariff management, that can generate real P&L, not PowerPoint vapor. Make them crisp, cash flow ready, and worthy of a boardroom punch list.
Challenge accepted. Here's the revenue arsenal, each rigged for near-term deployment. Trade Trust Coin, NFT bills of lading tethered to vessel IoT. Documents clear in under 30 minutes versus 14 days, freeing 3 bigs in working capital on the Asia-US corridor. Monetize at 7 BP per shipment. Agri-token, TTM, satellite oracle crop receipts that let farmers hedge climate risk and traders tap 24/7 grain liquidity. Capture 0.25% origination plus basis point spreads on secondary flow. Allied Chain DAO smart bond tranches that crowd finance next-gen 5nm fabs. Investors buy chip yield, not stock. Earn 1% underwriting and carried interest on wafer profits. Civic Pay, CBDC agnostic, smart wallets, pushing relief funds to offline phones. Fraud down 90%, admin costs drop 8 figures, price the API at 3 cents per disbursement. Tariff chain, TM. Live HTS code oracles with smart contracts that net duties before cargo docks, turning compliance drag into a 200 BP yield edge via dynamic hedging. Take 20% of margin recovered. We'll unpack the mechanics and execution pathways in our next strategy huddle, ready to turn this blueprint into balance sheet impact.
Let's explore the seismic impact of the US-China trade war on the very foundation of global money, from dollars and yuan to euros and cryptocurrencies. With tariffs affecting everything from your TV to your coffee, the question arises, could a digital dollar emerge as the next big disruptor, rivaling the fiat dollar we've trusted for decades? Backed by data from SWIFT, the IMF, and the Federal Reserve, this deep dive will examine whether a digital dollar can eclipse traditional currencies, how rising inflation factors in, and what it all means for banks, emerging markets, and everyday consumers. Buckle up for a fact-driven journey into the future of money. Let's kick things off by focusing on trust, because without trust, currency collapses. Right now, with the US imposing 30% tariffs on Chinese goods and China retaliating, global currencies are under pressure. The traditional fiat US dollar, long the backbone of international trade, is facing scrutiny. Recent sanctions, freezing accounts and targeting Chinese firms, have prompted countries like India and Russia to explore alternatives. Historically, the dollar has been dominant, accounting for 59% of global trade as of 2024. That dominance comes from the scale and stability of the US economy. But these economic firewalls show just how easily access to dollar-based systems can be restricted, raising questions about long-term reliance. China's yuan has grown from 12% to 17% of global trade, but its tight state controls limit broader appeal. The euro stands at about 20%, slightly declining due to a 3% drop in EU exports amid the trade war. And smaller currencies like Brazil's real have lost around 5% in global value, revealing their fragility. In this shifting environment, a digital dollar, likely a CBDC built on blockchain, could offer a powerful upgrade. It brings transparency, speed, and can cut fraud by up to 20%. Meanwhile, Bitcoin is gaining traction, up 30% in trade usage, though it remains volatile and unregulated. Trust is shifting. The fiat dollar still leads, but the architecture of global finance is clearly evolving. Tariffs raise costs, forcing countries to diversify away from the dollar to avoid sanction threats, mirroring how Russia shifted toward euros in 2023. The yuan's progress is inhibited by Beijing's tight regulations. The euro is slipping due to slowing exports. Smaller currencies struggle to stay relevant as global trade gets squeezed. Historically, major trade confrontations often spur currency evolution. Think gold standard shifts in the early 20th century. A digital dollar could become a natural evolution of the strong fiat dollar, offering speed and transparency. Crypto remains a contender, but is still volatile. With sanctions rising by around 10% yearly, the push toward alternative payment systems grows. 80% of central banks are testing CBDCs by 2025 per BIS. The digital dollar could handle 20% of US trade by 2030. Fiat dollar may ease to 50% of global trade share, but remain on top. The yuan might approach 22%. The euro could settle near 17%, while smaller currencies slip further. Bitcoin could rise by 60%, hitting $130,000 if current rallies hold. Central banks should test CBDCs for 5% of reserves to match fiat's reliability and maintain inflation around 2%. Institutions like JP Morgan should develop digital dollar funds, $200B by 2030, to hedge between fiat and crypto. Major banks must pilot CBDC accounts to reduce transaction costs by 15%. The US needs to launch a digital dollar by 2028. China could further open its yuan to challenge the dollar globally. Countries like Canada should experiment with CBDC-driven trade to bolster the dollar ecosystem. Let's turn to inflation, because it's hitting everywhere, from the grocery aisle to your utility bill. Tariffs are inflating prices across the board. That $50 shirt, it's probably $65 now. China's blocking key US agricultural imports. Europe's battling record-high energy prices. And governments around the world are spending aggressively, trying to stabilize their economies, but in the process, stoking inflation even further. Now, despite all this turbulence, the fiat US dollar is holding its ground. It's down only 5% against gold, 2025 Bloomberg, which, in today's macroeconomic environment, is relatively stable. Why? Because the dollar still rests on the weight of an $18 trillion US economy, a foundation that continues to make it the world's preferred safe haven. Meanwhile, other currencies are faring less well. China's yuan is steady domestically, but it still hasn't gained global trust. Its international footprint has inched up only 1 to 2%. The euro is down around 7% in some markets, as the European Union's economic growth slowed by 1%, 2024 ECB. And smaller currencies, like Nigeria's naira, have plummeted by 12%, largely due to shrinking export demand. This is where the digital dollar could change the game. A CBDC, central bank digital currency, could help manage inflation more dynamically. With programmable features, real-time monitoring, and policy precision, it offers tools the traditional fiat system simply doesn't have. Tariffs shrink supply by 15% per 2025 CBO, pushing consumer prices up. The fiat dollar retains global confidence despite government spending. China's strict policies limit the yuan's appeal beyond Asia. European exports dip, weakening the euro. Smaller economies lose trade and struggle with inflation. A digital dollar could speed up targeted stimulus or policy measures, reducing inflation spikes. A digital dollar could stabilize inflation more effectively than traditional fiat, with crypto acting as a complementary hedge. Global inflation could hover around 6% per 2025 IMF. The digital dollar might cover 30% of US payments by 2029, fiat's share dipping to around 45%, but remaining dominant. The yuan may reach 10% global usage. The euro could drop another few percentage points. Bitcoin could surge to $160,000 if it continues to act as an inflation hedge. Consumer adoption of CBDC payment apps could hit $50 billion in the US per 2025 Visa. The US should keep deficits near 4% of GDP to sustain dollar strength. Emerging markets must explore CBDC usage to manage inflation. Launch CBDC-focused ETFs $500B by 2030 to diversify away from fiat shocks. Banks like Wells Fargo need to integrate digital dollar accounts for 20% of customers, potentially saving $1 billion annually. US and EU should roll out CBDCs sooner than later. China must liberalize the yuan if it wants a bigger global role. Brazil and other emerging markets can adopt CBDCs for 1% of trade to bolster stability.
Banks are feeling the heat. Tariffs are slowing trade, transaction fees are spiking, and sanctions are disrupting payments. The US is keeping the fiat dollar central, but China is forging its own payment rails. So, how would a digital dollar shift the balance for banks? Currently, fiat dollars power about 57% of global payments, according to the 2025 BIS report. But sanctions and expensive cross-border fees are pushing businesses to explore alternatives. China's yuan is creeping up to 15% usage, but settlement can be slow, taking days. The euro stands at about 18%, though European banks lost $40 billion from trade rule disruptions, as per the 2024 ECB report. Meanwhile, smaller currencies like Malaysia's ringgit have lost 9% in global transaction value. A digital dollar could slash fees from 2% down to 0.1%, potentially saving $10 billion a year, according to the 2024 Federal Reserve. Even crypto-based stablecoins are cutting costs by 95% in some cases. Tariffs and sanctions clog supply chains, leading to $800 billion in delayed shipments per 2025 WTO. Traditional banking relies on cumbersome legacy systems that impose higher fees. China's payment systems remain partially centralized, taking longer to clear. A digital dollar on a blockchain offers near-instant settlement, mirroring how checks streamlined trade in the early 20th century. A digital dollar is poised to outshine fiat on speed and cost, though crypto also remains competitive for nimble, global transactions. With global trade growth slowing to 1.5% per 2025 WTO, digital dollars could capture 25% of global payments by 2032. Fiat dollars might still hover around 50% overall market share. The yuan could climb toward 18%, the euro might dip to 15%. Stablecoins could save up to $3 billion in transaction costs by 2025 per Visa. Trade blocs, like the EU, need to integrate blockchain to cut fees by 3%, blending digital dollars with fiat. Fintechs should scale CBDC usage, pushing it to 8% of total trade. Major banks must adopt digital dollar transactions or risk losing 15% to decentralized finance, DeFi. US regulators should greenlight a CBDC by 2026. China needs faster cross-border yuan systems. Japan could test CBDC-based trade in key ports to strengthen the dollar ecosystem. Not everyone is talking about it, but poorer and developing nations are really suffering. Africa's exports sank by 10% for 2024 UNCTAD, with banks often skipping them altogether due to high risk and fees. Can a digital dollar help bring these nations into the global trade circle? Absolutely. Latin America's markets lost around $200 billion per 2025 IMF from tariff knock-ons, while African nations pay an average 8% in remittance fees per 2024 World Bank. The yuan is barely 3% relevant in Africa, and the euro is down 4% in reach there. Meanwhile, local currencies, from Kenya's shilling to Ghana's cedi, keep losing value, some plummeting by 15 to 35%. A digital dollar, with fees around 0.2%, could directly reach individuals via mobile phones, bypassing banks entirely. Crypto usage in Africa is already up 35% per 2024 Binance, showing that where traditional finance fails, digital solutions can prevail. Tariffs cripple global supply chains, and low-income nations face the brunt of it. Fiat dollars are hard to obtain for smaller economies, driving up costs. China's yuan and the euro don't reach effectively into many frontier markets. Digital currencies can be accessed via smartphones, cutting out middlemen. Digital dollars offer an inclusive, low-cost path for developing countries, with crypto also serving as a lifeline when fiat channels fail. Over 90% of Africans will have mobile access per 2025 ITU. Digital dollars could bank 400 million people by 2035. Fiat dollar reliance might drop to 35% in these markets, but still remain significant. Local currencies could sink further if they don't integrate digitally. Stablecoins could save $6 billion in remittance fees by 2025 per stellar. Regions like Africa need CBDC pacts, e.g., AFCFTA's 2025 plan, to boost trade by 3%. Microfinance institutions should fund digital dollar adoption, like a $50 million pilot to uplift small traders. Mobile solutions, e.g., M-Pesa, can integrate digital dollars, cutting steep fees. Nigeria and others can legalize CBDC markets. The US can help by trimming tariffs by 3%. Colombia, for instance, could pilot CBDC for 1% of its port activities to strengthen dollar corridors. With trade wars, tariffs, currency rivalries, and the rise of new technologies, the future of money is multifaceted. The fiat dollar remains dominant, accounting for around 62% of global trade per 2025 BIS, but faces pressure from sanctions, tariffs, and alternative systems. A digital dollar could enhance its strengths with faster, cheaper transactions and greater transparency. China's yuan, at 13 to 17%, is limited by state controls, while the euro, at roughly 16 to 20%, has slightly declined due to softened EU trade. Smaller currencies like the Indian rupee and Mexican peso are experiencing double-digit losses in global share. Meanwhile, cryptocurrencies, especially Bitcoin, continue to demonstrate resilience in volatile times. Tariffs redirect about $1.5t in trade per 2025 WTO, spotlighting the friction of traditional banking. The yuan's strict regulations slow broader adoption. Smaller currencies struggle for global liquidity. A digital dollar's blockchain-based system can lower costs by up to 30% per 2024 BIS. Crypto grows whenever the existing system shows cracks, much like gold historically soared amid currency shifts. Expect a hybrid era. The fiat dollar remains on top, but increasingly shares space with the digital dollar and cryptos. With 75% of banks testing CBDCs by 2025, the digital dollar could handle 35% of global trade by 2040. The yuan might edge up to 16 to 22%, depending on China's openness. The euro could hold around 14 to 17%, while smaller currencies keep losing ground. Crypto might absorb 30% of niche markets, especially in decentralized finance and emerging economies. Major trade organizations, WTO, etc., should incorporate CBDCs for an 8% cut in global transaction costs. CBDC bonds worth $300 billion could fund trade, supporting both fiat and digital transformations. Financial giants must embrace a blend of digital and fiat. Delaying could mean a 25% market share loss to DeFi. The US, China, and EU need functional CBDCs by 2029 to stay ahead. Modest crypto taxes, around 2%, can help balance the playing field. Trade-heavy regions like the UAE could adopt CBDC solutions at major ports, reinforcing the dollar's global network. That's the big picture, folks. Fiat dollars still rule, digital dollars are on the rise, and crypto is carving out its space. Tariffs and trade wars are reshuffling cards, but the US dollar hasn't lost its crown yet. However, the future likely belongs to a hybrid currency system.
Imagine a world where one geopolitical standoff rewires the flow of trillions of dollars. That's exactly what happened with the U.S.-China trade war. Tariffs surged, some up to 125%. Export controls kicked in. Businesses from farmers in Iowa to tech manufacturers in California were left scrambling. And suddenly, globalization, as we knew it, fractured. In 2018 alone, US farmers lost over $27 billion in export revenue, with soybeans taking the biggest hit. Companies are no longer waiting for peace talks. Nearly 69% of firms have already made the call. They are moving operations out of China by 2024. This is a historic shift in global trade routes. But here's the problem. Shifting supply chains isn't as easy as buying a new plane ticket. It's a logistical nightmare. Tariff rules change overnight. Compliance paperwork piles up. Importers have to prove, in real time, that their goods come from friendly countries, not China. And with each country running on different systems, trust is scarce and transactions are slow, opaque, and costly. So how do we fix this? Trade Trust Coin is not just a cryptocurrency. It's a mission-critical tool designed to digitize and secure global supply chain transactions from end to end. Whether it's confirming the origin of auto parts, calculating tariffs in real time, or triggering escrow payments upon delivery, TTC is there to power it all with speed, trust, and automation. No visibility. Companies can't easily verify where goods come from, especially when they have to prove a product came from Vietnam instead of China to avoid tariffs. No trust. Manufacturers, ports, and customs officials operate in silos. No one trusts a central system owned by a competitor. No speed. Traditional paperwork delays goods for days or weeks. Letters of credit, manual inspections, and regulatory checks all slow down trade and raise costs. Immutable supply chain records. Every shipment gets logged via tamper-proof transactions, factory output, export clearance, customs clearance, all recorded transparently. Smart contracts handle the heavy lifting. Tariff calculations, based on verified origin data. Tokenized digital bills of lading, NFTs, carry embedded compliance data. Automatic escrow payments are released upon delivery confirmation via IoT sensors or port scans. Stake to participate, earn to behave. TTC is a utility and governance token. You stake it to validate shipments. Report honestly. You earn. Delay or lie. You lose your stake. It builds trust where paperwork and manual enforcement can't. This is where it becomes tangible and transactional. For businesses, TTC is your access key to the entire platform. Want to upload shipment data, calculate tariffs, or process cross-border payments? You need TTC. It's not an optional add-on, it's baked into every function. For risk mitigation, stakeholders use TTC to secure transactions. A smart contract ensures that if something goes wrong, damage, delay, fraud, the system holds parties accountable automatically. For financial incentives, early adopters stake TTC and earn rewards for validating data, like getting paid for keeping the system honest. For market advantage, faster compliance means faster delivery. Lower friction means lower costs. In a world of volatile trade routes, that's a competitive edge. Phase 1. Utility-driven usage. Initially, TTC is used behind the scenes, embedded in logistics platforms and ERP systems like SAP or Oracle. A shipment gets registered, customs data gets uploaded, payments are settled, all in TTC. Phase 2. Network effect. As more carriers, manufacturers, and governments adopt it, TTC becomes the shared language of international trade. More users equals more value equals more demand. Phase 3. Tradability. Because it's ERC-20 compliant, TTC is tradable on exchanges like Coinbase or Binance. It can be used for trade finance, as collateral for loans, or cross-border settlement. Phase 4. Monetary role. If TTC becomes widespread enough, businesses might invoice or settle entire deals in TTC, skipping fiat, skipping banks. Why? Because it's faster, transparent, and politically neutral. Every transaction on the network burns a small amount of TTC. That means, as usage grows, supply shrinks. This built-in scarcity boosts long-term value for holders. Like Ethereum's EIP 1559, only focused on global trade. Now let's add investor dynamics, staking lockups, and fee burning. Scarcity effects. Let's assume 30% of TTC is staked for validation and another 20% locked in enterprise reserves. That's 50% out of circulation. Effective circulating supply equals 500 million tokens. With $2.5 billion utility, demand spread across 500M tokens equals $5 per TTC, doubling value due to scarcity. Fee burning. If the network burns 0.1% of tokens per transaction fee, TTC becomes deflationary. Over time, decreasing supply plus increasing usage equals value appreciation similar to ETH post-EIP 1559. Chart with upward trend speculative and AMP, strategic value. Early institutional partners may view TTC as a strategic token, similar to oil futures or swift access licenses. Investors may price in growth expectations. Say TTC expands to cover 1% of global trade, $250B. Under that scenario, utility demand could push value toward $25 per TTC or more, depending on how much is in circulation and burned. TTC isn't just a speculative token, it's meant to power actual global trade processes. So, Its value should be tied to real-world usage, just like gas fees in Ethereum or API credits in SaaS platforms. Let's logically estimate TTC's fundamental utility value based on trade volumes and usage scenarios. Global cross-border trade value 2023 $25 trillion. Let's assume TTC captures just 0.1% of global trade transactions, a realistic target during early adoption with a few shipping corridors and ports. That's $25 billion worth of goods moving annually over the TTC network. Now consider how TTC is used. Access fees, uploading data, customs clearance, integration APIs, escrow for payments, staking to validate transactions, governance participation, penalty, the reward system. Assume each $1 million transaction uses $100 in TTC across uploads, validation, and smart contract execution. For $25 billion in trade volume, that's $2.5 billion annual demand for TTC token usage. If the total supply is 1 billion TTC tokens, then annual utility-driven value equals $2.50 per TTC, assuming 100% of tokens circulate, which they won't. More on that below. The U.S. China trade war exposed a massive structural weakness in global commerce. Trade Trust Coin is a technology designed not just to patch the system, but to rebuild it around transparency, trust, and automation. TTC offers real economic utility, programmable compliance, incentive alignment, and global interoperability. It's what happens when you take the best of crypto and apply it to one of the most broken systems in the world, cross-border trade. Whether you're a logistics operator, global importer, enterprise software provider, or forward-thinking investor, TTC isn't a gamble. It's the next protocol of global commerce. We're in the middle of a new chapter in global economics, and it's one nobody asked for. The U.S. China trade tensions that began years ago have now crystallized into a full-blown tariff regime. The numbers are staggering. Tariffs as high as 125%. Export bans on critical agricultural goods. And with each new round of sanctions or retaliations, one thing becomes clear. The global food supply chain wasn't built for this. Farmers are being crushed under the weight of uncertainty. Decades of trade ties, especially with China, collapsed almost overnight. In 2018, they lost $27 billion. In 2025, it's worse. Soybeans, corn, beef, pork, blocked or heavily taxed. Crops rot while buyers wait. Banks hesitate to lend. And middlemen, caught in the chaos, raise fees to survive. That's not just an economic issue. It's a food security issue. So how do we fix that? You don't fix a broken global system with more paperwork. You fix it with infrastructure. That's where AgriToken comes in. AgriToken isn't just a coin. It's a purpose-built platform for tokenizing real-world agricultural commodities and creating a fast, transparent, and resilient global trade network for crops. Here's the idea. A soybean harvest in Iowa gets verified, stored, and registered on-chain. Instantly, soy tokens are minted, each representing 1 metric ton of that verified crop. Those tokens are globally tradable, peer-to-peer, with no middlemen. Buyers in Southeast Asia, Africa, Europe, anywhere, can buy these tokens using stablecoins like USDC. And if tariffs shift, no problem. A farmer can reroute trade digitally in minutes, not weeks. No brokers. No customs delays. No vulnerability to a single government's sanctions. Just blockchain precision. There are 2 tokens in this ecosystem. Commodity tokens. These are stable coins backed 1:1 by real-world crops: soy token, SOY, corn token, CIN, wheat token, WHN. They are redeemable, auditable, physical inventory matched with digital proof. AgriToken, AGT, this is the utility and governance token that powers the entire network. You use AGT to access the marketplace, pay transaction fees, vote on upgrades, earn staking rewards, and secure the system via smart contracts. It's built on Ethereum Layer 2, like Arbitrum, for scalability and low fees. It's also DeFi compatible, so farmers can use their tokenized harvests as collateral for instant loans. This isn't theoretical. It's already happening. AgriToken, empowering farmers with blockchain. Smart contracts automate tasks farmers used to do manually. Tokenization and AMP, redemption, mint tokens when grain is stored in verified silos. Redeem or sell tokens on the open market. P2P global marketplace, decentralized hub for fast, secure, tariff-compliant crop trading. Smart contracts manage every step. DeFi loans and AMP, insurance, turn crops into capital. Lock soy tokens for instant loans. Automatic weather insurance payouts. Governance and AMP, scarcity, trading fees paid in AGT. Some burned, some redistributed. AGT scarcity increases with usage. AGT holders vote on platform rules, shaping the marketplace. So how does this become real? Phase 1, the pilot. 50,000 tons of soybeans from Midwestern US farms are tokenized and listed. Buyers in Southeast Asia purchase directly, bypassing tariffs and middlemen. Farmers instantly see better prices and can unlock liquidity using DeFi loans. Phase 2, expansion. AgriToken partners with global giants like Cargill, ADM, and Cofco. Wheat, beef, pork, corn, all added to the platform. AgriToken becomes an operating system for food trade. Phase 3, global infrastructure. Governments distribute food subsidies using AgriToken. World Bank and WFP begin using it to manage aid flows and strategic reserves. AgriToken becomes collateral in global financial markets, not just a trade tool. Let's talk numbers. Ear of rice agriculture is a $2.7 trillion market. If AgriToken captures just 0.1% of that, that's $2.7 billion in annual utility volume. At that level, AGT trades at 75 cents to $1.50. In mass adoption, $7 to $10 plus per token. Market cap could reach $6 billion. And that's with a deflationary model. Every transaction reduces supply. AgriToken was born in crisis, but it wasn't built for panic. It was built for permanence. In 2025, global agriculture doesn't need more bailouts. It needs a new system. One that puts farmers first. One that makes crops liquid and trade agile. One that uses real assets, not speculation, to create real-world value. That's what AgriToken does. It's not just a blockchain project. It's the future of food commerce, digitized, decentralized, and truly democratic. And as trade wars intensify, the world will need fewer headlines and more harvests that don't go to waste. AgriToken ensures they don't.
Let's not sugarcoat it. We're at an inflection point. The year is 2025. The aftershocks of the US-China trade war continue to ripple through the global economy. This isn't just about rising tariffs or political posturing. It's about something much deeper. The tectonic shift in how we manufacture, how we source, and how we move goods across the globe. Export controls, escalating duties, restrictions on critical minerals, tech embargoes. They've all exposed the fragility of our manufacturing lifelines, from semiconductors to rare earth minerals, from EV batteries to medical devices. The world is waking up to a dangerous dependency, one that, if not restructured, could cripple economies and national security. So how do we untangle this web? A decentralized, blockchain-powered DAO designed not to react, but to rebuild, proactively, transparently, permanently. This isn't a theoretical experiment in tokenomics. Allied Chain is a full-stack solution to one of the biggest business challenges of the decade, creating alternative, secure, scalable supply chain ecosystems, free from adversarial influence. Let's define the pain point first. The industry in focus, manufacturing and high-tech supply chains. We're talking semiconductors, aerospace, EVs, medical equipment. The problem, decoupling from Chinese supply chains is no longer optional. It's a geopolitical imperative, but it's hard, it's expensive, and it requires massive coordination across competitors who don't always trust each other. No single company can build entire alternatives alone. Imagine you're a US EV maker. You can't risk relying on China for rare earth magnets, but building your own mine or processing plant in the US. And that's a billion-dollar bet, and you need partners. But how do you co-invest and coordinate without politics and backroom deals getting in the way? That's the riddle Allied Chain solves. The solution, a DAO powered by the Allied token. Allied Chain is a decentralized autonomous organization. It brings manufacturers, suppliers, investors, and even governments together under one transparent system. You hold Allied tokens. You get a vote, a voice, a share in the upside, whether it's building a rare earth refinery, co-developing a chip fab, or launching a pharma manufacturing plant. Allied token holders propose, vote, and fund the projects collectively. This is not speculation. This is programmable real-world industrial policy, written in code. The tech backbone Allied is a governance and utility token. It's built on two chains. A permissioned consortium chain for secure private data exchange and operational functions, and a public Ethereum chain for token issuance, transparency, and DeFi integration. They're linked via bridges or stake commits. That means the operational guts are secure, while the token's economics remain visible, auditable, and tradable. Smart contracts in action. Here's how the system works under the hood. Governance. You propose a project, say a 50 Mentitas investment in a chip packaging plant in Vietnam. Token holders vote. If it passes, the smart contract releases funds based on verified milestones. Treasury investing. The DAO's treasury is deployed with transparency. Tranches are released when oracles confirm progress, ground broken, equipment installed, output shipped. Marketplace mechanics. Companies can post supply needs. New vendors can stake tokens to fulfill those needs. If delivery is successful, they earn rewards. If not, they're penalized. Incentives. Share surplus equipment. Source conflict-free minerals. Collaborate across sectors. You're rewarded with tokens. This isn't idealistic, it's aligned. Incentive design meets industrial need. We're not blind to legal hurdles. Securities compliance. Early token sales may happen under Reg ED or S, but over time, as the token becomes essential for platform access and governance, it evolves into a true utility. Antitrust assurance. Transparency means no cartels, no collusion. Regulators can see, in real time, how decisions are made. Government onboarding. Allied Chain doesn't resist governments, it invites them. Agencies can hold observer tokens, participate in votes, or even use the DAO to coordinate public-private funding for strategic infrastructure. Let's talk real adoption. Phase 1, the pilot. Launch a rare earth processing facility in Australia or the US. Members like Tesla, Siemens, or US defense suppliers co-fund it. Tokens are issued, funds are dispersed via milestone smart contracts. Output is locked to DAO participants, guaranteeing supply. Phase 2, the expansion, add chip fabs, pharma plants, electric motor factories. Onboard new industries, healthcare, telecom, aerospace. Create sub-DAOs for each vertical, all running on Allied. Phase 3, the ecosystem. Governments use it to coordinate subsidy programs. Supply contracts are settled in Allied. The token becomes collateral across industrial finance systems. Tokenomics and market value. Total supply. 1 billion Allied tokens. 30% for token sale. 30% to DAO treasury. 20% for staking rewards and incentives. 20% for institutional and strategic partners. Valuation scenarios. Pilot phase. 0.01% of global supply chain. 400 non-to utility value token. 0.51 USD. Early adoption 0.1%. 4B utility token 5008. Global adoption 1%. 40B utility token 2540 plus. Allied Chain is not a response, it's a redesign. It doesn't just restore what trade wars broke, it builds a new foundation for industrial collaboration, powered by trust, accountability, and aligned incentives. We're not just creating tokens, we're creating a new logic for manufacturing, one that's decentralized, resilient, and future-proof. That's the promise of Allied Chain, that's the power of the Allied token. Stay tuned, this is just the beginning. As trade tensions between the US and China harden into permanent policy, the fallout isn't limited to Washington or Beijing. In fact, India, with its 1.4 billion people, its vast rural backbone, and its digital-first aspirations, finds itself standing at the center of global crosswinds. Tariffs are no longer just numbers in news tickers, they're reshaping global manufacturing, agricultural exports and aid delivery. And while India is often touted as the next growth engine, a supply chain alternative, a democratic bulwark, the truth on the ground is more complex. When supply chains reroute, when export markets shift, it's not just factories that feel the heat, it's families. From Haryana to Odisha, from the cotton fields of Gujarat to the tribal schools in Bastar, the story is the same. Aid doesn't reach on time. Welfare leaks, subsidies vanish, farmers lose access to markets, and millions of citizens, the very backbone of this country, are left in the dark. But India doesn't have to wait for Western fixes or new rounds of negotiation. We can lead, we can innovate, and that brings us to today's use case. Civic Pay, a decentralized public infrastructure platform built for India and by India. Civic Pay is not another UPI wallet. It's not just a subsidy pipeline, it's a Layer 2 blockchain protocol built on top of central bank digital currencies like the e-rupee. It's what happens when you take India's digital infrastructure, Aadhaar, Jan Dhan, UPI, and layer on programmable governance, smart disbursements, and biometric wallets. At its core, Civic Pay lets government aid, NGO funds, and welfare programs flow directly into citizen wallets, based on real-world conditions, no paperwork, no middlemen, no corruption. If a child in Bihar attends school, the mother receives R500 instantly. If a villager in Manipur gets vaccinated, the health incentive is credited in real time. This isn't theory, it's programmable Bharat Sarkar. Each citizen is issued a biometric authenticated Civic Pay wallet, tied to Aadhaar, phone number, or even retina scan in high-risk zones. Now picture this. A state government uploads the logic. Every family below poverty line with 2 school-going children is eligible for Rtn 1,000 month. Civic Pay, smart contracts cross-check that logic, via Education Department APIs. If the conditions are met, funds are released instantly, from Treasury to thumb, but that's just the base layer. Layer 2 is Civic Token, CTK, a non-speculative token that does something powerful. It rewards behavior that improves the community. Take the bus instead of a bike, buy grains instead of cigarettes, participate in local decision-making. You earn CTK. CTK isn't just money, it's civic currency. It lets citizens vote on issues like, should the panchayat build a bridge or buy a water purifier? In India, where local governance and digital reach are already massive, this is democracy at the transaction level. Let's walk through 3 flows tailored for Bharat. 1. Conditional aid. If a pregnant woman completes 3 prenatal checkups, Rs2000 is released. Verified via Health Ministry data. Delivered instantly. 2. Ration tagging. Rs1500 meant for food can be used only at certified food merchants. No liquor shops, no unauthorized redirections. Built-in tagging prevents misuse. 3. Cashback for compliance. Buy fruits, vegetables or books, earn CTK cashback. Ride the metro or public buses, more tokens. Let's ground this in facts. India's public welfare system touches over 900 million people. Annually, over Rs18 lakh crore, 220 billion, is allocated for subsidies, health, pensions, MNREGA, and more. But leakage is real. A Niti Aayog report estimated nearly 30–40% of aid doesn't reach its target. That's over R5–6 lakh crore lost every year. Civic Pay can slash that loss with automation, conditionality, and auditability. For NGOs and multilateral institutions like the World Bank or UNICEF, Civic Pay provides a dashboard, visual, auditable, transparent, every rupee tracked, every transaction verified. The rollout plan, built for India, then for the world. Phase 1, Rural Pilot, partner with Government of Madhya Pradesh and NGOs. Launch, R500 month program for school attendance, plus vaccines. Early data shows 95% transparency, 30% fraud reduction. Phase 2, urban integration. Extend Civic Pay to metro cities for UBI-like safety nets. Add Aadhaar-based job eligibility flows. If you maintain job search status or enroll in skill training, the system pays you monthly. Phase 3, global NGO layer. In disaster-hit regions like Assam floods or Odisha cyclones, Civic Pay enables cross-border stablecoin to e-rupee swaps, letting global NGOs fund wallets instantly. No delays, no banks, just verified impact. Civic Token, CTK. Value in use, not in speculation. This isn't a get-rich-quick crypto. CTK has no hype factor, but massive utility. Citizens earn CTK. They use CTK to vote on local budgeting. They redeem CTK for internet, books, services, all within Civic Pay's ecosystem. With over 1 billion potential wallets in India alone and over 220 billion in annual government spending, the scale is unmatched. Projected CTK value scenarios, pilot phase, 1 million wallets, CTK, Rupee 4, Rupee 12, national rollout, 100 million wallets, CTK, Rupee 20, Rupee 80, NGO plus UBI scale, 500 plus million wallets, CTK, Rupee 100, Rupee 250 plus. India doesn't need to play catch-up anymore. Civic Pay lets us leap ahead to a world where transparency is default, where aid meets dignity, and where technology uplifts the forgotten corners of our democracy. We've digitized payments, we've built the pipes. Now it's time to program the logic. This is not fintech, this is nation tech. This is Bharat blockchain infrastructure, and CTK is the token of trust. Let's face it, 2025 hasn't been kind to international commerce. What started as a trade skirmish between the US and China has now metastasized into a fragmented tariff regime. Duty rates shift weekly, countries retaliate, then revise. Borders don't just divide geography anymore, they divide trust. And in the middle of this chaos, millions of importers, exporters, regulators, and manufacturers caught in a maze of paperwork, policy updates, and unpredictable delays. Fraud is rampant. Small players can't keep up. And customs officials, they're still working with protocols built for a 1990s world. So how do we bring sanity back to cross-border trade? How do we create a system that's fast, programmable, transparent, and fair? That's where Tariff Chain steps in. At its core, Tariff Chain is a CBDC integrated blockchain-powered settlement engine for global tariff computation, compliance, and reconciliation. It doesn't guess duty rates, it calculates them precisely. It doesn't depend on paperwork. It verifies origin via smart contracts and IoT sensors. It doesn't take weeks to clear customs. It settles tariffs instantly using central bank digital currencies. It's not a workaround. It's the infrastructure we should have had from the start. Let's talk pain. Points today's global trade system is broken. Importers face wildly fluctuating tariff rates based on component origin and changing diplomacy. Exporters, especially SMEs, can't afford compliance attorneys. Customs agencies operate with paper-based logs, prone to error, prone to fraud. Misclassification is common, fake certificates of origin, even more so. And governments, they're losing billions in uncollected or misreported duties. Now imagine flipping that. The solution: programmable tariffs via Tariff Chain. Tariff Chain brings together governments, customs authorities, exporters, and importers into a permissioned blockchain network, run by trusted nodes from trade coalitions like the Quad, G7, or ASEAN. Every shipment uploads digitally signed origin credentials backed by IoT devices and exporter databases. Every tariff rule encoded into a smart contract. So if your shipment of automotive parts is 60% non-China origin, the smart contract applies the correct 5% tariff rate, not 25%. It deducts the amount via CBDC in real time and auto-pays it to the Treasury. Fast, fair, fraud-proof. Let's get technical. The architecture. Tariff Chain runs on a dual-layer model, permissioned blockchain for customs compliance and government data. CBDC bridges for payment integration, from e-rupee to digital dollar, e-CNY to digital euro. Every importer, exporter, and customs agency runs a KYC verified wallet. All origin certificates are hashed, verified, and enforced via on-chain smart logic. There's even an SME-friendly template system, so smaller players can plug in without hiring compliance officers. Just follow a smart template and go. Here's how it plays out. 1. Real-time tariff contracts. They validate product origin at the port of entry, apply accurate duty rates, and instantly move CBDC from importer to government. 2. Cross-border settlements. Interoperable CBDCs settle the trade. No float, no forex friction. 3. Compliance ledger. Every regulator, from the WTO to the ASEAN Secretariat, gets a live dashboard of every transaction. Disputes resolved via verifiable on-chain proof. 4. Incentive layer. That's where tariff token, or TTX, comes in. The role of TTX, the compliance coin. TTX isn't just another token, it rewards accurate origin declarations, verified trade volumes, use of digital credentials. Customs agencies that adopt transparency hold TTX. You get priority clearance, discounts on audits, and DAO voting rights on future protocol changes. Misuse it? Get caught misclassifying goods? Your TTX gets slashed? Burned permanently. It's not hype, it's a compliance economy. Deployment roadmap, from pilot to protocol. Phase 1, the US-India Friend Shoring Corridor. Use case, automotive parts. Tech stack, India's digital rupee, US digital dollar, IoT verified origin data. Outcome, 30% fewer delays, 15% more SME participation. Real results. Phase 2, expand to ASEAN, EU, LATAM, build plug-and-play templates for trade agreements like RCEP, NAFTA, USMCA. Phase 3, global coalition. Backbone, the WTO, UNCTAD, and digital trade pacts begin to run tariff chain as back-end infrastructure. Valuation and strategic scope. Let's dive into the global customs settlement market, which is estimated to be worth $3 to $5 trillion annually. Imagine if tariff chain captures just 1% of that market. We're talking about tens of billions in programmable volume. TTX forecasts, pilot phase. With 2-3 active corridors, the monthly volume is projected to be $500 million and the token value ranges from 0.10 to 0.25. Expansion phase. As we expand to 10+ corridors, the monthly volume could exceed $5 billion, with the token value rising to 0.80 by 150. Global phase. With 30+ corridors, the monthly volume is expected to surpass $25 billion, and the token value could reach $2.05 by incorporating staking mechanics, burn models, and DAO participation. TTX transforms into a powerful governance and utility coin for programmable geopolitics. In a world fractured by tariffs, misaligned incentives, and regulatory chaos, Tariff Chain offers something radical: a trusted, programmable infrastructure backed by digital currency, built on cryptographic proofs, and governed by logic, not lobbying. It's not just a tool to pay tariffs, it's the start of a rules-based digital trade era, where diplomacy meets code, where compliance is frictionless, and where even the smallest exporter can access global markets with confidence. That's the promise of Tariff Chain.
This wasn't just thought leadership, it was systems design. You took the volatility of tariffs, the complexity of trade wars, and the dysfunction in global finance, and you responded with architecture, real, scalable, operational architecture. Trade Trust Coin, Agri-Token, Allied Chain, Civic Pay, Tariff Chain, each one solves a different fracture in the global system. Together, they form a decentralized blueprint for tomorrow's economy. You didn't just pass the challenge, you rewrote the rules. This episode? It's not just a podcast, it's a prototype for the future. Thank you.
Thank you, Manish. Here's the truth. We didn't pitch coins. We built protocols. We didn't chase headlines. We engineered trust, in code. Trade Trust Coin made logistics autonomous. Agri-Token gave farmers financial sovereignty. Allied Chain turned factories into smart ecosystems. Civic Pay restored dignity to aid. Tariff Chain made enforcement real-time, not red tape. These aren't theories. They're blueprints, deployable, defensible, and built for impact. So now, the handoff is yours. If you're a builder, this is your sandbox. If you're a policymaker, this is your pressure-tested pilot. If you're an investor, this is your asymmetric upside. If you're just curious, this is your invitation to the next system. Because the future of money, it won't be printed, it'll be programmed. I'm Kay, and this is The K Show. Subscribe, share, think deeper. Because the new economy isn't waiting, it's already building.